Would you pass up $2.8 million? That's how much more money one real estate investor had to their net worth in a simulation I ran compared to the runner up. Same deals, same timeline, same money going into savings. But one small decision made his family $2.8 million richer. My name is Slater. I'm a Yale alum and real estate finance consultant, and in this video, I'll show you how one single tweak in your strategy can mean millions more for your net worth without changing the way you invest. If you stay around till the end, I'll let you in on the 3 things to avoid so you don't fumble this strategy. Let's get started. The simulation follows two longtime friends, A for Adam and B for Barry. Both were competitive commercial real estate investors in their 40s. They frequently talked about the financial futures they wanted to build for their families: college tuition, a business fund, a legacy, not just properties on a spreadsheet. The two talked cap rates over cold brew, compared IRRs at charity dinners, and got giddy over rate drops at golf. Now, they each had the same goal: become a 7 figure cash millionaire before retirement without getting reckless. So, they drafted a conservative game plan: aggressively save a total of 500K over 5 years, buy a property at 75% LTV for 250K down, and don't buy again until they could replenish their down payment in full. Every few years, they meet at the same cafe, usually after a refinance or a new acquisition, to swap notes and take jabs at each other. 20 years passed. 3 purchases, 3 exits, same dollars reinvested, identical on paper. But their outcomes? Not even close. By year 4, Adam grinned as he held the lead, 18K ahead. He joked over espresso, "You're gonna need a miracle to catch me." Barry just smirked and sipped his pour over. Slow and steady wins the race, buddy. By year 9, Adam was still up, barely. He didn't understand. It was like Barry had bigger and bigger gains every year, but interest rates had hardly shifted. All this work, and he was losing his lead. And by year 14, Barry quietly pulled ahead, 878K to 851K. No fanfare, big speech, just a quiet, "I told you so" over croissants. By retirement, Barry crossed the 7 figure line first. They were equals in every way: income, strategy, deal flow. So when Barry won the rat race, Adam didn't just lose money, he lost confidence. He did everything right, or at least he thought he did. The sting wasn't just financial, it was the gut punch of realizing someone else got it right and he didn't. Not because he didn't work hard, but because Barry knew something Adam didn't. And despite this pain, the real shock came years later when both men passed away 10 years into retirement. You see, Adam left just under 1.47 million to his family, but Barry, he left over 4.3 million. One grew by just over 60%, the other by 380%, a $2.8 million difference. Now, Barry died a few months after Adam and couldn't help but reflect on his deathbed. He got to see with his own 2 eyes the legacy Barry left behind. His friend's children had a foundation, college paid for, business capital, real estate, seed money, debt eradicated. But Adam's kids got less, a lot less. And not because he didn't love them, but because no one ever told him there was a better option. The pain isn't in what he had, it's in what he could have had. If only he had stored his capital into whole life insurance instead of his 3% APY savings account. That one change would have made all the difference. So, what can we learn from this story? And how can we avoid ending up with financial regrets like Adam did? We obsess over interest rates, rent rolls, and cap rates, pivoting to cheaper insurance, saving on property taxes. But how often do we stop to ask the most basic question? Where is the money sitting between deals? For most investors, that capital's in a savings account, quietly underperforming while you wait for the next opportunity. And in those gaps, those in between years, your wealth is bleeding slowly and silently. That's where Barry made his move. And it's why Whole Life didn't just catch up, it blew past Adam by millions. But why? Why did Whole Life outperform so drastically? Here are the 3 reasons Barry came out on top. The first being tax drag. Savings account interest is taxed every year, eating into compounding. Barry's policy grew tax deferred and stayed that way for 30 years. That gave him more efficient compounding and a bigger long term return. The second is uninterrupted growth. Adam had to withdraw his cash for every down payment, losing interest in the process. Barry borrowed against his policy. That meant his full principal kept growing as if he had never touched it. And yes, I factored in the interest on those loans. In fact, I added Barry's loan interest as extra deposits to Adam's account. Whole Life still won. The third is the death benefit. Barry's final net worth wasn't just cash, it included his policy's death benefit. That final boost created a 4.8x return on his premiums. No other savings tool in the world besides life insurance ends with a guaranteed multi-million dollar tax-free payout to your family. And now, despite all these benefits, you might be thinking, but Slater, interest rates change. How do other interest rates perform? I tested that too, using a 0.1%, 2%, 3%, and even 4.5% APY account. Whole Life lost early on, no question. At year 4, Whole Life was in fourth place, just ahead of the 0.1% rate. But by year 30, Whole Life surpassed even the 4.5% account in first place by over $300,000. And again, that's without the death benefit. Factoring that in, and you're looking at a $2.5 million advantage in Whole Life's favor. And if you want the full numerical breakdown of the simulation comparing whole life to savings accounts, you can join the newsletter in my description below. Just reply to the welcome email with the title of this video and I'll send the PDF your way. But all that being said, what does this mean for you? Before you rewrite your strategy or rush to buy a policy, there are 3 things you need to know. The first being to always pay back the loan. Barry didn't treat policy loans like free money. He used capital from strategic exits to pay them off. That's how he kept the compounding engine running. Just so you know, I tested the simulation first without paying the loans back and then paying only interest. The results were miserable. Whole Life couldn't even beat the 0.1% APY, and that's not even worth your time. The second step is to design the policy correctly. Not all whole life policies work like Barry's. You need custom structuring for early liquidity and long term growth, and most agents simply don't know how to do this right. I spent an entire morning and the early afternoon selecting the right company, tweaking the policy, and managing my Excel spreadsheet to make sure Barry's policy was as efficient as possible. A different design could have limited his performance. And number 3, stay in the game. Interest rates may change. Sometimes high yield savings accounts look like a dream, but other times interest rates plummet. In fact, we just saw this in the 2010s. Great for your mortgages, terrible for your idle cash. But whole life during the same decade would still be netting you returns that beat even 4.5% Fed rates, let alone sub 2% rates. This strategy isn't flashy, it's not exciting, but slow and steady crushed the competition. It built wealth quietly, consistently, and with a death benefit that could change your family's future forever. But whole life has a few more moving parts than a savings account and works more like a line of credit. That means you need to watch this video next to learn how whole life compares to credit lines when funding your investments. See you there.